In this market analysis, we are going to dive deep into one of the biggest questions in crypto right now. Will Bitcoin and the rest of the crypto market peak in late 2025? Or could this bull run continue all the way into 2026?
Many will sell and then get trapped out, and then they'll expect an early peak, and maybe it does peak, still suggests that it peaks at the end of the year, towards the end of the year. The people who then sold out, maybe they screwed it up, and maybe they got out like I did in 2017, way too early. You then try and buy it back, and you end up buying back at much higher prices.
The market is buzzing with speculation, and there's a lot to unpack. We'll explore the historic 4-year cycle, what's different this time, and what the charts and market data are really telling us. So make sure you stick around, because by the end, you'll have a clear picture of what could happen next, and how you can stay ahead. First, let's talk about the argument for a peak in 2025. The idea of a 4-year cycle in crypto is almost legendary at this point. Bitcoin's previous major peaks came in December 2013, December 2017, and November 2021. Each cycle followed a similar rhythm. A massive surge into the fourth quarter, followed by a sharp correction. Why does this happen? Well, every prior cycle has been influenced by the Bitcoin halving, an event that cuts the supply of new coins in half. Historically, this supply shock triggers upward momentum roughly 12 to 18 months later. And when enough traders, funds, and retail investors expect this pattern to repeat, it can actually become a self-fulfilling prophecy. People buy in anticipation, pushing prices higher and creating momentum. Each cycle brings new money into the market. Pullbacks shake out weak hands, and rallies build confidence. By late fourth quarter, especially in previous cycle years, confidence often spills into mania. That's when altcoins thrive as money rotates from Bitcoin into Ethereum and riskier tokens. Right now, we can see some hints of this pattern. Bitcoin has slowed after a big surge, Ethereum is testing new highs, and altcoins are waiting for rotation. But here's a twist. September has historically been the weakest month for crypto. Over the past decade, both Bitcoin and Ethereum often drop in September due to global liquidity drying up, mutual fund rebalancing, and stock market corrections. This doesn't mean the cycle is over. In fact, it can be the perfect buying opportunity before a final leg higher. In 2017 and 2021, September losses were followed by explosive rallies into the end of the year. So the 2025 peak argument is strong. The halving occurred in April 2024, Ethereum is breaking resistance, and altcoins are poised for rotation. Add September's seasonal pullback, and it could act as a slingshot for a classic cycle finale. But here's the thing. Crypto is changing. Previous cycles were mostly retail-driven. In 2013, it was retail traders on exchanges like MtGox. In 2017, ICOs dominated the scene. In 2021, DeFi, NFTs, and retail adoption drove parabolic gains. Now institutions are taking the lead. Spot Bitcoin ETFs, Ethereum treasuries, pension funds, and corporate allocations are the primary buyers. These institutional players behave very differently from retail traders. They accumulate steadily, manage risk carefully, and don't panic sell at the first sign of volatility. Their presence could make price movements smoother and reduce the extreme spikes we've seen in past cycles. Spot ETFs are particularly important. Every time a pension fund, sovereign wealth fund, or corporate treasury allocates to crypto, coins are bought gradually from the market. These inflows don't disappear suddenly, which could prevent sharp crashes. With institutions controlling more of the capital, the market's highs and lows may be less extreme, possibly stretching the cycle into 2026. There's also a bigger macro picture to consider. Crypto now reacts more to global liquidity than before, and global liquidity is strong. The Federal Reserve is signaling potential rate cuts, and trillions of dollars sit in money markets ready to flow into risk assets like crypto. The Fed chair transition in 2026 could also influence the cycle. Historically, markets tend to rally ahead of a new Fed chair nomination as investors anticipate easier policy. If this pattern holds, crypto could stay supported well into mid-2026, with major corrections only appearing once the new chair officially takes office. Add moderate inflation, ongoing government spending, and continued stablecoin growth, and the environment looks favorable for extending the cycle. These conditions suggest that even if history points to a 2025 peak, there are real reasons this bull run might continue further. Looking at the market itself, some key signals from previous cycle tops are still missing. Euphoria. In past peaks, mania was obvious. In 2017, billions flowed into ICOS overnight. In 2021, NFTs and memecoins dominated headlines. Today, Bitcoin's fear and greed index is mostly neutral, not greedy, and altcoins remain subdued. Retail mania hasn't returned. Parabolic moves. Cycle tops usually have extreme vertical price action. Right now, Bitcoin is consolidating, Ethereum has modest gains, and altcoins haven't hit speculative highs. Stablecoin supply. Historically, the growth of stablecoins signals internal crypto liquidity. Currently, stablecoin supply is still climbing, meaning capital is ready to flow into crypto, which could fuel more gains. Distribution by long-term holders. Some early Bitcoin whales are transferring coins into ETFs or selling into strength, but this is part of a process of distributing coins to new long-term holders. A cycle isn't complete until this distribution finishes. All of this suggests the market still has room to run, and that a peak may not happen immediately in late 2025. So how do we balance these perspectives? On one hand, the 4-year cycle and historical patterns argue for a 2025 peak. On the other, institutional participation, macro liquidity, stablecoin growth, and the absence of mania suggest the cycle could stretch into 2026. It's possible that institutions smooth out volatility, extending the bull run. But if momentum accelerates late in 2025, even cautious institutions could chase returns, potentially creating euphoria and a classic cycle peak, but this time with larger sums of money. For now, the safest assumption is that the market may follow a hybrid path, familiar 4-year rhythm mixed with new structural dynamics. That means we could see some big moves in late 2025. But the ultimate peak might not arrive until sometime in 2026. Here's what this means for everyday investors. Stay aware of the seasonal patterns. September pullbacks could be the last opportunity to buy before a rally. Monitor institutional activity. ETFs, corporate treasuries, and pension fund flows are shaping the market differently than before. Watch macro conditions. Liquidity, Fed policy, and fiscal spending could fuel gains longer than the historical cycle. Track market signals. Euphoria, parabolic price moves, stablecoin growth, and distribution patterns tell you whether a cycle top is near. By keeping an eye on these indicators, you'll have a better chance of understanding when the market is heating up or when rare buying windows appear. And of course, you already know that Bitcoin is the future. That's why you have to start teaching your kids about it now, before it gets too late. This teen ebook is the perfect place to start. Link is in the description.